right? Because we all have to eat still. We all have to turn our lights on. So utility stocks play pretty good defense.
Can you make a case for defensive investment strategies and options in the midst of market volatility? We will talk about it today with Chris McIntire, president and founder of McIntire Retirement Services, Northwestern Ohio, your resource for a common sense approach to planning and the game plan for retirement. It is a written plan for your investments, your finance, your retirement future. If you'd like to get that put together, Chris always makes his time available for listeners to this program. All you need to do is pick up the phone, get the conversation started by calling 419-332-0532, 419-332-0532. But Chris, I'm sure that you're hearing a lot about market volatility and the potential for some defensive strategies right now.
Yeah, absolutely. It's the theme of the year, if you will, as we head into through the second quarter of 2025. And, the reprieve on tariffs for 90 days gave a little relief in the stock markets here recently. But what does that mean come about day 75 is what's going to happen between now and then. So, you can certainly make a case for being defensive right now for sure.
Is the little reprieve that we've gotten maybe the opportunity to do so?
Yeah, it certainly is, because all right, hey, you had a nice bounce back up. And it's like, okay, you know what? I'm going to take some of the riskier stuff off of the plate, maybe your growth stocks and the tech stocks, that type of thing, and work your way into consumer staples, right? Because we all have to eat still. We all have to turn our lights on. So utility stocks play pretty good defense. And even, there's an exchange traded fund, an ETF, consumer staples, and it's actually positive for the year as of our recording here today.
But in reality, Chris, like who knows what the future holds, right? Things seem to be anything but predictable right now.
Yeah, no question about it. And whether you support the president and voted for him or you didn't vote for him, there's where do they stand on everything? Where is the baseline, what we're going to get? And and I think if we get a few announcements on some new trade agreements or some headlines that China says, hey, you know what, we'd like to have a talk, a person of direct contact, and let's stop insulting one another, basically were the headlines this morning here that, as we're recording. And that's the start of a negotiation because, look, you got to be careful. Trade wars can lead into real wars. And we know China is being very aggressive toward Taiwan, where 95% of the computer chips get made, and we get a lot of minerals to build our defense industry, for the things that we need to keep Americans safe globally come from China. So I understand that hey, nobody wants a lithium mine in their backyard, but China's holding us hostage, and maybe we do need to create some more of that here on the domestic front, and with and take into consideration all the environmental concerns, right? I don't think anybody wants to see a big pit in the ground, and we got to be good stewards of the environment to throw that out there as well.
Well, we have, as a result of the tariffs and the trade wars and the political uncertainty, seen market uncertainty as well. Having a plan ahead of time always puts you in the best position to weather potential market volatility and uncertainty, but reactively making some strategic moves and moving defensive may also hold merits. Now, there is a time and a place for risk. And Chris, we've been taught often to take risk with our money for the main reason that it is equated inherently with higher returns and that those two things are intrinsically linked. Is that necessarily true? Like everybody loves risk when the market's moving up, but the real test of risk is when the market's going down and there aren't those positive returns.
Sure, yeah, I mean, we had several folks that were insistent on moving into cash and missed a 10% bounce in the stock market the next day. So you've got to be careful there. Do emotions take control? And can you still risk when things are going real well, the momentum is going forward, and Nvidia stock and the tech bubble, the Magnificent Seven, if you will, in like 2023, those seven stocks were really rocking and rolling, and the dividend payers were flat for the year. So, man, there's times in this economy where a small sector is doing well, the rest of it's kind of flat. And, that's why you have to diversify your portfolio. And, in times like these, nobody's really been through a trade war. I mean, we've never really been through a pandemic. We never really had a housing crisis like we had. And it's like, hell, I just turned 60 years old. My hair is getting gray. All these, it's about every 2 years, 2.5, 3 years, we have something crazy going on that hasn't happened before. And God forbid we get some sort of widespread conflict going on with all the new modern weaponry. I mean, who knows what the hell could happen out there.
Well, that's why we have to plan for the future, prepare, but plan for the future. And that game plan for retirement looks for long-term strategies, diversified strategies. Your personalized goals are kept in mind as that is being designed, and that's what Chris McIntire helps to design for his clients there at McIntire Retirement Services, the game plan for retirement. So again, personalized to you and your situation with those goals in mind. If you'd like to get that put together, pick up the phone and give a call, 419-332-0532, 419-332-0532. Chris, again, a number of reasons why we are taught to take risk, right? To achieve higher returns, beat inflation over time, build wealth over the long term, meet future financial goals. But risk can be managed, right? And there's a case for that risk management and some of those defensive strategies certainly to be had as well.
Yeah, we've always been advocate of having a safe strategy in addition to your investment strategy. And that could be as simple as keeping some money in a money market account within your investment portfolio for those just in case pieces. Or maybe you've got, a CD at the bank, a fixed annuity or a fixed index annuity that's safe. And, we're actually taking some free withdrawals out of some annuities that we have that are safe, and just taking a free withdrawal and bringing that and putting some of that money back into some clients' portfolios and taking advantage of a dip in the marketplace. And things we utilize in defensive measures as well is not just having the money market, the CD or the annuity piece. Those are all quality pieces, but within the investment strategy, our folks that have been in an income type portfolio looking for dividends and interest, and through our partners at Brookstone Capital Management, we use some things called structured notes, which provide a high degree of principal protection, until the market drops by 30% on some high yielding notes that we call these structured notes. And typically they are safe from any market loss until one of the stock market indices is down by 30%. So that's a pretty good protective barrier. We have some buffered strategies that provide you some protection of the first 15% drop in the market, or from -5 to -35 is, some popular strategies we utilize. Trying not to get too specific here on the radio show because, kind of hard to internalize this, but, and then dividend paying stocks typically hold up pretty well in market turmoil like this. Doesn't mean they don't drop in value, but still paying the dividend. And, typically it's the flight to safety, right? I know I got to turn my lights on. I got to walk into the Walmart store. I got to buy something from Procter and Gamble, just to get through life. I got to still wash my clothes, that type of thing.
So there are options that can mitigate or absorb some of the downside, or generally are not as exposed to the fluctuations, more stable and steady. So defensive and conservative strategies. Chris, are these two things interchangeable, or is there an inherent difference between defensive investment strategies or conservative investment strategies or options?
Yeah, and defensive would be playing consumer staples, still staying in stocks, but just different types of stocks, utility companies. And then a conservative strategy might be adding in bonds, if you will, also. So you got a stock bond mixture there. A lot of people have heard of the 60-40 portfolio. That's kind of a moderate profile. And we've had a lot of clients come in where we've taken them from moderate down to conservative in that portfolio, upping that bond bond sleeve. And, I think it's probably fair to say, or safe to say here on the show, that the U.S. government bonds have been in the headlines here lately as well too. Because China and Japan owns more U.S. government debt than any other country. China is second. Okay, other foreign country. Obviously, we own some of our own, and there's was talk that they could dump some of our treasuries and weaken the dollar, that type of thing. And I think they probably did some of that, a week or so ago. And that brought Trump to the table to say, hey, we're going to put a 90-day waiver in here on the tariffs. So is that the start? If we're playing a 9-inning ball game, Peter's son is a good baseball player, so it is a good baseball reference, folks. He's a good pitcher too. Are we in the first inning, the bottom of the first inning? Are we in the third inning? I think most of us would agree we're not in the bottom of the ninth right now.
Right.
And how long does this game take to play? A baseball game sometimes can take 4 hours if we get a rain delay or something, and or sometimes you get a good day and they play it in 2.5 hours. We don't know that yet, guys. It's pretty early into this.
Yeah, yeah, and they always have those extra innings sometimes. How about you mentioned government bonds like treasuries, right? And how about bank style options, money markets, CDs, things along those lines? Chris, are they still holding their own with the interest rates? I know we were seeing really fantastic interest rates. Well, comparatively, looking back at less than 1% where we were pre-COVID, I guess.
Yeah, good point. Yeah, that's for sure for a very long time. And then, in 2022, the interest rate spiked. So in 2023, we were buying, 5.2, 5.3% CDs all day long. And then last year, rates started coming down as inflation was getting under control there. And I looked the other day, I was on the Charles Schwab website looking at CDs we could purchase, and they were about 3.9% for 1 year CDs. And I suppose you could shop around maybe and see something, but heck, you can make that in a money market right now without tying your dollars up. So we're still using a lot of money market funds. And here's the a money market fund is typically 1 to 3 month US government bonds. Okay. Just kind of that, quick liquid type investment piece. And those have been holding up a little better than CDs, which are a little more regulated by, I won't say regulated, but dictated by the Federal Reserve rate there, the federal funds rate coming from the Federal Reserve versus the bond market on money markets.
And the point of investing, Chris, I know we need some savings for that liquidity and safety. Your dollars are there, but the point of investing is to grow your money at or above inflation. Hopefully that second, right? Above the inflation rate is the purpose. And I feel like at 3 and 3.5 and even 4, like we're basically just treading water with where inflation has been.
Yeah, for sure. If you're just keeping pace with inflation, that's, right now you might call that a victory given all the market volatility. You say, look, my focus right now is not losing. And then I'll worry about inflation later. And nice thing is inflation is still, coming down more so. Oil prices have come down pretty significantly here, and that's a double-edged sword. It's like, all right, why are they coming down? Well, the economy's slowing down, given some of the controversy around tariffs and whatnot, how bad could the damage get? But still, it's nice having a safe money strategy. We just passed April 15th. I had to use some of our emergency funds to pay the, Internal Revenue Service. I shouldn't call them emergency funds, but our cash supply. And that's kind of typical for us. Peter's self-employed as well. We make our scheduled tax payments, and April 15th can be a funny one because you might owe a little bit extra when you're self-employed from what you planned on. So you got to make that and then make your first quarter payment as well, too.
Yeah. Yeah.
Don't get me
Again,
started.
well, at least it's behind us for now. But those tax days always seem to come right back around. And Chris, I know that part of the planning and I think playing into this conversation, conservative and defensive strategies can include the tax conversation as well. In fact, being tax efficient and savvy is as effective as shooting for higher returns, but generally with far less risk. And so I know we want to talk about some of these conservative and defensive strategies like asset allocation and diversification and buy and hold and dollar cost averaging, but tax planning is a big one that goes into the game plan for retirement as well. And just a quick plug again, ladies and gentlemen, if you'd like personalized strategies for how to be efficient as possible with your long-term financial investment, retirement, and tax outlook, pick up the phone. Make sure you have a game plan for retirement. You can get it there at McIntire Retirement Services. Give them a call, 419 332 0532, 419 332 0532. I asserted that, Chris, but would you agree? Do tax strategies fall into the category of defensive or conservative strategies?
You could say, you're taking advantage of an opportunity, I suppose. So if the market dips significantly, do you convert some IRA money, move those assets or some of them into your Roth IRA and then let them recover on that side? Because you're paying taxes on maybe, your Tesla stock that's fallen by 50%. You move it into your Roth IRA and, hopefully that would increase in value. And I hope that's an okay analogy to use here.
Right. And sometimes, Chris, that is done on purpose, realizing losses to wash against gains, right?
Yeah, without a doubt, buddy. I've done some of that already myself, just to, and I can rebuy that same investment 31 days later. And I've done that. We have a significant amount of money outside of our IRA accounts, had some decent losses in there. Like, all right, I'm going to sell this Tesla, for example. I'm going to sell my Tesla stock and I'll rebuy it in 31 days if I want to. But I've locked in that loss and then I can use it to offset future capital gains down the road. So if I'm just using a number here. If I lost $10,000 on my Tesla stock that I sold, okay, down the road, if I make $10,000 on it, I can sell it and then offset it with that loss and not pay any capital gains taxes. So we call that capital loss harvesting.
All right. Well, and then I know Roth conversions, Chris,
Yeah.
even in the midst of volatility and down markets, you say if we are properly positioned, if we have planned to be efficient and do Roth conversion strategies, there can be cues and opportune moments within volatility if there are market losses to realize a silver lining of that gray cloud and do even the intended Roth conversion more efficiently.
Yeah, I like that. Silver lining of a gray cloud. That's a pretty good analogy there, buddy. You've been doing this a while.
Yep. Well, and I know you've been helping clients move assets over, get them out of those tax deferred assets over to the Roths. And that is something that you do on an ongoing basis and is part of the game plan for retirement. So, again, ladies and gentlemen, if you'd like to get that put together for you, pick up the phone, give a call, 419 332 0532, 419 332 0532. So, how about the old asset allocation and diversification? Does diversification give us the fallback? I won't call it a safety net, but help buoy a portfolio like it once did during volatile times in the stock market, Chris?
Yeah, it certainly can. These are the times where, you're happy that you have put some of these pieces in place. If you've listened to good, solid advice to say, look, we got a defensive strategy in place here. We can, take advantage and move some of that safe money back into our risk bucket, take advantage of the dips in the market here. Instead of being greedy and letting when the market runs, it's hard. I understand, you say, well, boy, the market's running pretty good here. Do I invade my safety cushion to add more money to my risk bucket? And, you got to, do that carefully and make sure that, because this market whipsawed pretty quick. If you look at the days it took to drop, 10, 12, 15%, man, it came heavy. That's for sure.
And how about income focused investing? I know that there are several options that can fall into this category: dividends, bonds, annuities. Is that more of a defensive play or a conservative approach to investing, Chris?
Yeah, typically it is because you're buying, kind of big bellwethers there, if you will, the big stocks, the Procter and Gamble's, the Johnson and Johnson's as example, brand name companies, and dividends are just profits. Um, And I've always been a dividend stock fan. We use preferred stocks as well that pay a higher dividend, right? You're not going to double your money in a year or two typically on these types of investments, but you're going to get a nice solid payout. And if you need that payout for your living expenses, so you couple that with, maybe some nice bonds or bond funds to help get some interest coming in as well. We use those flash notes that we get from Brookstone. Some of those are 8 to 12% interest, depending on the underlying issuer, and they're as safe as the underlying issuer as well, right? A lot of times we're Morgan Stanley, Bank of Montreal, Bank of America, UBS, many of those big companies that do these structured notes, flash notes that we call them, covered call strategies using option ETFs to help drive nice income. The annuity side, we typically use as a safe money strategy, plus the income element that you have on an annuity. And that's how the outside of your Schwab, your Vanguard, your Fidelity investments, that's with an insurance company. And your goal there is to protect, grow, and possibly take income off of it as well. So, it's kind of like, most people, their plan A strategy, if they have some degree of risk tolerance, is their investment portfolio. Their plan B might be the annuity side. If you're more conservative, you might say, I've got some annuities laddered out here. I can take one, and then I can turn on another one for income, for inflation means and whatnot. And then I've got a very conservative investment portfolio just in case I need some liquid cash. So, you can tailor these across the risk profile of any clients.
Are annuities still offering attractive interest and growth and crediting and payout rates, the income that somebody can generate from them like they were, Chris?
Yeah, they're, right now, because interest rates had gone up significantly in 2022 from where they were in 2020, for example, again, basically zero. We've gotten a lot more competitive rates on 2, 3, 4, 5 year annuities that are competing against the CD side of things that, I'll probably still get, 4 to 5%, depending on the year, how many years you're looking at, the liquidity that you need. We use the index annuities where you can, get some growth based off of the S&P 500. Some of them offer you a nice bonus if you'll come in and you'll sign up for an annuity. They might give you a 7, 10, 15% bonus, first year starting bonus, to help you recover some losses or something like that, or moving from one investment to another. So many different flavors. So, when somebody says, well, I'm not really sure I understand annuities. Like, well, that's because there's a lot of them. Not many people understand all 8,000 mutual funds that there are out there to buy either. And I guess that's what gives that's job security for us, is to help educate our clients and help them make the best decisions that they want to, and and use the leverage of some very large institutions to their advantage.
Another tip for maintaining a good psychology, working with a fiduciary professional to structure that plan, get that game plan for retirement put together, ladies and gentlemen. Give McIntire Retirement Services, Chris McIntire, call 419-332-0532. Chris, over time, as the market moves, we could start or become imbalanced and overweighted in our risk exposure. The value of regular, routine, strategic, and tactical rebalancing can also help us maintain a more conservative or defensive positioning.
Yeah, rebalancing is very important. And, typically if you're working with a financial professional, you're going to probably have like a quarterly rebalance. And what we mean by that is, let's say you were 50% stocks, 50% bonds, and the stock market fell by 15%. Okay. Well, now you got more of a bond allocation. So at the end of the quarter, you might sell some of your bonds and put some more money back in stocks, taking advantage of buying at a lower price. Conversely, on the other side, if the stocks go up significantly, then eventually you'll sell some of those stocks to stay in that 50-50, and you're pulling some of your gains off and making them a little bit safer. So rebalancing is certainly very strategic plan. And so is, like Peter says, tactical, taking advantage of like the Magnificent Seven then when they run in 2023, and like right now, maybe more on the defensive side of stocks would be a tactical move that you're making as well.
Well, ladies and gentlemen, we've seen some market volatility, uncertainty, unpredictability, and we want yet our financial future to continue to make progress on track, and therefore market volatility can be unnerving. Having a plan helps us financially and psychologically, and that's the value of the game plan for retirement. Give McIntire Retirement Services and Chris McIntire a call. Get the plan in your hands to help you make sure you're making that forward financial progress, regardless of market conditions. Specifically, if you'd like to learn how to retire, want to learn how to pay less in taxes, keep more of your money, just give McIntire Retirement Services a call to get that conversation started. 419-332-0532. 419-332-0532. Get the game plan for retirement in your hands to finish strong in 2025 and all of the years beyond. And we got a lot of year left. Who knows what happens, but a plan will help you make progress through whatever comes our way. So again, give McIntire Retirement Services a call, 419-332-0532. Chris, always a pleasure, and we appreciate the time and the insight.
Yep. Thanks, Peter. Good to be with you, everybody. God bless America, and we'll talk to you next week.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Structured notes involve risks not associated with an investment in ordinary debt securities. The securities are not bank deposits and not insured by the Federal Deposit Insurance Corporation, FDIC, nor any other government agency. They are not obligations of or guaranteed by a bank. The securities will not be listed on any securities exchange, and secondary trading may be limited. Therefore, there may be little or no secondary market for these securities. Accordingly, you should be willing to hold your securities to maturity. The securities are subject to the credit risk of the issuing bank, and any actual or anticipated changes to its credit rating or credit spreads may adversely affect the market value of the securities.